Good afternoon. This is Richard Comotto, and I'm going to talk about the ICMA repo survey for December 2019. First of all, I apologize for the lateness of publication, but like convoys, we have to proceed at the speed of the slowest ship. And we received our last contribution last week. Unfortunately, we would have liked to receive two other contributions, but they weren't forthcoming. And the banks that are missing are substantial in size and therefore make a difference to the survey, which is why we tend to wait for them. But with what we've got, which is in fact 58 institutions this time round, you can see from the first slide that the headline number is 8.3 trillion. So this is, just to emphasize, this is the measure of the outstanding size of our survey sample. It's a snapshot on the 11th of December last year. It doesn't measure turnover, and therefore you have to be careful in the interpretation of these numbers. Outstandings tend to understate the importance of short-term transactions. Our numbers exclude central bank repo, and there is no adjusting for double counting where two survey members report the same transaction between themselves. We don't think, however, that double counting is a very serious issue. We don't think it accounts for more than about 15% of the survey. And on the contrary, our survey is only a partial reflection of the European repo market. We don't know what percentage we have, perhaps 80%, perhaps 70%, but this number effectively represents the floor to market size. On this slide, I've compared our survey number with the figures for US primary dealers. They are thought to account for 80 to 90% of the US market. You'll see the same essential profile to both of those lines, but at different levels, and the angles of the trajectories of the two lines are very different. Europe has recovered much more sharply than the US. Now, we are working on the basis of 58 reporting institutions. 39 of them are in the EU, 3 are from Norway and Switzerland, and 16 are established or based in North America or Asia. But these are all operations within the European geographical area. I did note that we lost 2 large contributors, hopefully only temporarily. On the other hand, we have 3 new contributors, Standard Chartered, ANZ, and Nykredit Bank. And because of the loss of the 2 large existing contributors and the entry of 3 new contributors, you have to be very careful in interpreting trends. There's been, in effect, a structural shift because of the change in the composition of the survey. In terms of the latest survey, it represents, if you just look at the headline numbers, a year-on-year increase of plus 5.9% and an increase since the June survey of plus 7.1%. Now, because of the change in sample, we have to be careful using those numbers. So what we also do is do a same for same comparison. We take the survey number of the institutions that have been in the last 3 surveys and recalculate the growth rates. And if we do this, the headline increase of 5.9% year on year becomes 2.1% year on year. And the increase since June of 7.1% becomes 3.5%. There are 51 institutions that have taken part in the last 3 surveys continuously. So just based on them, we get slightly lower growth rates. Looking at the returns that we get, out of a sample of 52 banks that have been in the last 2 surveys, 28 increased the size of their repo books and 24 decreased them. If we move to the trading analysis, then the most noticeable change here is a rebound in the share of voice brokers who've otherwise been on a secular decline over the period of the survey. Voice brokers' share increased from 8.1% in June to 9.9% in December. We think some of that is due to a change in the survey sample. So again, have to be very cautious looking at that. Another important change is tri-party increased from 8% in June to 8.7% in December. And within that, the share of tri-party repo, which is accounted for by GC financing facilities such as Euro-GC pooling, for example, that increased from 10.5% of tri-party to 16.6%. So a very sharp recovery. The other thing to notice is ATS, so automatic trading systems. We're essentially here talking about BrokerTec, Eurex, and MTS. And their share has gone down slightly from 30.3% in June to 28.9%. But if we look at both that electronic trading and at tri-party trading, despite the change in share, the absolute size of those markets has hardly changed. So we get numbers reported directly by the electronic trading systems and directly by the tri-party agents. And if we look at those numbers, they've stayed very stable. So shares have changed, but not the outstanding size. So the outstanding size of electronic trading in December was 1.085 trillion. And the standing size of tri-party in Europe was 0.663 trillion. Moving to the geographical survey, then you see that there has been a secular decline over time in the share of domestic business, although that has been stabilized since about 2015. And that's matched largely by an increase in anonymous electronic trading. But we can get a slightly more detailed view. We can get a breakdown of cross-border trading, which has stayed fairly constant at a high level. And if we break that top green line, if we break it down, move to the next slide, you'll see that within that overall cross-border number, cross-border trading into and out of the Eurozone, okay, has been on a secular increase, whereas cross-border trading within the Eurozone has been on a secular decline. Moving to currency analysis, the largest share remains the euro, but as is shown by the numbers, that's dropped significantly. This is undoubtedly also the result of a change in the survey sample. But if we move to the next slide, we can see how these numbers have changed. You can see that the euro has been declining anyway as other currencies come into greater prominence, but the recent decline has been very sharp. And that's been matched largely by an increase in other currencies besides the dollar and sterling. So we've attributed that mainly to the change in the survey sample and the entry of banks like ANZ and Standard Chartered. Moving to collateral analysis, this is a core Eurozone collateral, and you can see that there has been a continued decline, in fact an accelerating decline in the share of German collateral. And in fact all Eurozone government bonds have a reduced share in the latest survey, but particularly German collateral. Moving to peripheral Eurozone collateral, then we see the secular decline and then rebound of Italian securities. That's actually been reversed slightly in the latest survey. Again, that's part of the general decline in the share of EU government securities. The exception being, as can be shown there, is Spain. I should emphasize that on electronic trading systems, however, Italian government collateral has sharply increased its share. Outside of the Eurozone, government security shares have increased. So UK government securities have gone from 11.9% to 13.4%. US Treasuries from 6.4 to 8.5, and JGBs 3.6 to 5.1. The next slide shows the last two of those securities. If we look at EU government securities overall, we can see the general decline that I referred to in the share of EU government securities. So this is EU government securities as a share of EU issued securities, and that's fallen back slightly from just under 90% to 89.6%. Contrasting with the picture from the survey, when we look at the numbers we've received from tri-party agents, the share of government securities in tri-party has actually increased, and that's been reflected in an increase in AAA and AA securities. But that's also been matched by a very sharp increase in the share of other OECD securities. But we have to remember that in the case of tri-party collateral, the shares are swung around quite a bit by the use of equity and equity valuations, which have changed quite sharply recently. In terms of maturity analysis, short dates have fallen back. This is the traditional seasonal impact. End of year maturities lengthen. But what's noticeable here is the shift into all maturities above 1 month. We believe that 1 month to certainly 6 months and perhaps longer reflects demand for high quality liquid assets, which is emphasized at year end. The other most significant figure to note is the sharp fallback in forward repo from 18.5% to 12.9%. Now, forward repo has taken an increasing share, reaching a peak of over 19% in the December 2018 survey, and that was attributed to the use of forwards to anticipate year-end pressures for collateral. The fallback in forwards, therefore, may reflect people being more comfortable with year-end after the tightness that we saw in 2016 and 17. And in the report on this survey, we've referred to Andy's report on the end 2019 market situation. Another thing to note from the maturity distribution on the left-hand side, a jump in the share of open repo. Now, this may reflect a change in sample, but it is quite significant, 6.6 to 9.6%. If we break down our numbers between repo and reverse repo, what's shown here is the flow of cash. So really money flowing from most maturities into maturities between 1 month to over 1 year. And we also measure minimum and maximum weighted average maturity. So for example, if you have a bucket like 1 month to 3 month, then the minimum WAM assumes everything's at 1 month, and the maximum WAM assumes everything is at 3 months. And you can see the general increase in the lengthening of maturities reflected in that WAM, in those WAM numbers. Rate analysis. So this has been a particularly interesting number in our latest survey. You can see that floating rate has dropped sharply from 14.1 to 9%. This follows the ERCC's decision that interdealer trading in floating rate repo, where the index is an overnight index, should be curtailed, and this is reflected in that number. If we look in the numbers provided to us by the electronic trading systems, the drop in floating rate is even sharper, 21.3% in June to 2.9% in December. It's also significant, though, that if we look at tri-party repo, there's been very little change in the share of floating rate repo. And this probably reflects the fact that tri-party is largely customer business, and the decision of the ERCC was focused on interdealer. Thank you very much. That's the survey. If anybody has any questions about it, please contact me directly. Be happy to answer them. Thank you very much.